Ohio gozaimasu. Welcome back to Money Media. James here, and today I want to discuss with you where I believe the Australian economy is heading into the back half of 2025 and then into the start of 2026. Now, before we get into the crux of this video about where I believe the economy is going, and I'll back everything up with data and information and things like that, but I just want to caveat this video by saying that humans are notoriously terrible at predicting the future, which is why I hesitate to call a recession incoming after 2025, be it 26 or 27. I believe it is likely that we will see a recession into 2026 and maybe over into 2027. However, I'm by no means ignorant enough to believe that I will be bang on with that prediction, because I just have seen throughout my career and my education that recessions are very rarely called. So, and you should know that as well, and you should take that into your own financial journey, understanding that you may hear a lot of people speculate about where the economy is going, and often they'll call for things that may actually not eventuate. So what I'm going to do is take you through a few key metrics that measure the economy, the Australian economy, and where they're currently sitting, and where also that they are trending, and why I believe that because of this, we will see a slowing or a cooling of the economy into the back half of this year, and a continuing trend of this throughout 2026 and maybe even as far as 2027. So the first metric that I want to walk you through is the cash rate. Now, the cash rate is essentially the cost of money that the RBA sets for all the commercial banks, and from that cash rate, we as consumers and personal investors may know it as the interest rate, which is what we're charged on our mortgages, etc. So the cash rate is falling and has been falling for a few months now, albeit not as slowly as most homeowners would like, but it is falling. And although it's coming off a pretty high space, respectively, a lot of investors would deem this as not falling fast enough. Now, a lowering cash rate is not necessarily a good sign in the economy. So when the RBA lowers the cash rate, what they're saying is that they're trying to encourage spending within the economy, more spending than what's currently going on. So if you'll recall, back during the back end of the C19 period, rates were starting to increase to try and cool inflation. Now, the reason why they were how they were cooling inflation was to slow down spending. So to slow down spending, you increase the cash rate, which means that money costs more, essentially. So when we start to see the cash rate lowering, what that's signaling is that the economy is starting to cool. So if you take a look at this graph here that I've got on screen, it gives us some information about the current interest rate of Australia. Obviously, from the 2024 high of 4.35%, which it flatlined at for quite a number of months, we've now, as of the most recent RBA meeting, we've come down to now 3.6% as the cash rate. I believe this will continue to fall. I believe we'll have another 3 interest rate cuts between now and the first quarter of 2026, and we may get another couple more into the next year, and I believe it will probably flatline after that. We'll probably end up sitting at around the 2.5 to 2.85% as the cash rate, which will encourage more spending within the economy. But as I touched on just a moment ago, this isn't necessarily a good sign. This shows that people are starting to get a little bit nervous about spending in the economy, and therefore taking on less debt and tending to increase their savings rates as well. So another important metric to consider with the Australian economy when we're trying to look at where we are in the cycle and where we are going is a metric known as the building approvals rate. So building approvals within Australia is a really important metric, because as you can imagine, when investors are a little bit nervous, cautious about the economy, the chances are that they're going to be holding off a little bit and not investing in that economy, being Australia. Whereas when building permits are high, when building approvals are high, that gives us a little bit of sense of confidence that investors and the data that they're looking at gives them enough confidence to be able to be entering into the market and investing in property. Now, we will look at this topic in a little bit of depth because there's a few catches here that I want to discuss. But essentially, if we look at the overall data of building approvals, we can see here, and if you look at the screen, we can see here that the data is that we're sitting at about a year-on-year metric of almost 28%. So what that tells us, and this is back from June, is the latest data, and what that tells us is from the June last year figure, although it being low, the June this year is almost 28% increase on what it was at the June of last year. So it shows against last year that the confidence is almost 30% increase. And so building permits have increased by essentially 30%. However, I want to caution this data, and this is why the detail is often really important. Now, if you look at the ABS building approvals and actually broken down by segment, what you can see here is it's essentially by detached dwellings, which excludes standalone houses. Now, this is a really important thing to consider because when we look at this and we look at some of these metrics that take into consideration the housing versus non-housing, we start to learn that it's not actually the building permit of houses themselves that is growing this trend, but it's the growth of building permits in multi-dwellings. So we're talking things like units, we're talking things like townhouses and terrace houses, etc. So that's a really important point. And when you look further into the detail, you start to realize that there's actually a big difference between private sector investing and personal investing. So if we break down this information into granular detail, we can see that the Australian investment lending for homes is actually higher now than it was during the COVID period, which looks very good. However, if we come over here and have a look at this graph that takes into consideration the private house approvals, just at a month on month, it's actually going into negatives. And so what that tells us and what that indicates to us is that although building approvals are quite high, it's not being driven by the mums and dads in the economy. It's actually being driven by larger investors, or dare I say it, larger corporations. Obviously in Australia, we have quite a decent demand for housing. We've seen that in sustained rental prices over the last few years. Obviously, our supply is constricted, for which Money Media, we've touched on this in many recent videos. What I believe we're seeing is an increase in development of multi-dwellings for large corporations and large investors to capitalise on that investment growth in a strong rental market. But I think we're actually seeing a decline in mums and dads building homes. And so if we separate those two out, what it tells us about the economy is that although large, essentially cashed up corporations and investors are eyeing our property market off for their financial gain, most smaller players in the market, which makes up most of our market in Australia, aren't all that confident in where our Australian economy is going. So that wraps up the building approval segment of what I'm interested in and why I believe the economy is heading into a bit shakier ground. Then I want to take you next into discussing the unemployment metrics around Australia and where they are currently sitting. So another important metric to look at when considering where the economy is growing and where it currently is at is the unemployment rate. And so in Australia, we've actually had a very low unemployment rate for the past couple of years, and it's sat stagnant, and up until recently where there has been actually quite a dramatic increase. And so I want to take you over to look at this graph so you can see the increase for yourself. So we've flatlined for essentially all of 2025 at the 4.1%. And then as recent as June, 4.3% has been our unemployment rate. So it's jumped 0.2 basis points to 4.3. And I believe that cycle will continue with the minimum wage increase that we saw as of early July. And I actually think because of that wage increase was announced in June, what I believe is that in anticipation of the minimum wage increasing, employers will probably slow to take on more employees or probably stop hiring altogether. So what I believe in the data is that we will see once July and August and September information data is released, I believe what we will see is a continuation of that trend from 4.3% to probably 4.6%, to be honest, maybe even a little bit higher. This is a really important metric to understand when looking where the economy is going, because it tells you about the job flow, and the job flow tells you about what kind of money is entering the system, if any at all. And so if unemployment is high, that means lots of people are looking for work. So if you don't have a job, if you're looking for work, you're going to be less eager to spend your money on luxury items. You're going to be more tending to build up your savings rate for security. Whereas when the unemployment is quite low, which is what we just came off, most people had discretionary spending. And so that's why we saw probably inflation being a little bit sticky in Australia, probably more stickier than many other major economies like America. So we've come off that low base of unemployment at the same time, coincidentally, when we've been actually starting to get inflation under control. So the two things are correlated. And I think we'll see an increase of this unemployment rise. And so what that means is less businesses having less cash through the door because less people have discretionary spending. The less employers who are hiring means higher unemployment, which means less discretionary spending, and the cycle continues. Economics is quite self-fulfilling in that way. And so I believe we will see a continuation of this trend into 2025 and probably into the start of 2026 as well. And it probably won't plateau until I'd say about the back half of 2026. So unemployment is a really important metric when discovering where the economy is going. And the final metric I want to run you through in this economic outlook video is inflation. Now, inflation is obviously been quite a hot topic in recent years because of the post-C19 era and what we've seen after excess money being printed in the system and how that affects the economy and the value of money. So I believe even laymen, even the people who I've associated with over the last few years who don't necessarily have much of a background in finance or economics have now started to understand what inflation is and how it affects them, because we did see quite high and violent inflation rates and then violent cash rate increases to try and counter that inflation. So where we are sitting may surprise you, and I'm assuming that most people aren't looking at the RBA data quite regularly, as I am. And so it may actually surprise you to know that our inflation, which should be in a target range of between 2% and 3%, is actually sitting now at a point of about 2.1%, and that's the CPI, which essentially goes into the inflation measurement. So sitting at 2.1% is the bottom edge of where we want to be. And this forms part of the reason why I believe that the RBA will continue cutting rates. I believe at least 2 more interest rate cuts in 2025. We've just had one being August, and I believe we'll have 2 more. And I believe we'll have a third either at the end of this year or early in 2026, first quarter at least. But I believe we may even slip lower than that 2%. Now, what that says about the economy is that, generally speaking, people are spending less money. So the more money that's getting spent in the economy, and again, there's a whole other video that I could discuss about inflation, but broadly speaking, the more money that is being spent or circulated within the economy means that it tends to drive inflation. Whereas if the participants in the economy, you or I, are less confident in the economy and what is going to be happening in the next 6 months, then we will slow our spending, we'll start to increase our savings rates. And what that will do is drive less money into the pockets of businesses, which means that prices tend to fall a little bit, unemployment tends to rise a little bit, et cetera, et cetera. And they are all correlated. And so I believe this inflation trend will actually continue down. I believe we will go lower than the 2% threshold, maybe 1.5%, maybe a little bit higher. Now, while this may sound good or appealing to you for inflation to be lower than the target range, which would mean that our money is increasing in value relative to the goods that we buy, instead of an inflationary period where the value of our money is going down. This may appear really nice and shiny on the face of it, but it's actually quite a concern, a deflationary period. And I want to give you an example right now. And this is a real world example. This is going on right now in Switzerland, where they are in a deflationary cycle of the economy. And so what this means is that the citizens of Switzerland, instead of buying goods, are actually holding on to their money and saving it. And so that is forcing savings rates higher, but it's also forcing costs down of goods. Now, while that may sound like a good thing, it leads to stagnation in growth of the economy. Because if you think about it, if there's something that you need to buy today in the economy that's $5,000, but tomorrow it's going to be $6,000, are you going to buy it today or are you going to buy it tomorrow? Well, most of us would buy it today. Now, that would be the scenario in an inflationary cycle. Whereas in a deflationary cycle, if you had to buy something today for $5,000, but there was the possibility of it being $4,000 tomorrow, most people would wait for tomorrow. And that's what we see in a deflationary cycle, is people tend to spend less, understanding that the value of their money is going up. They save more and they spend less. And that's how that feeds into the cash rate adjusting as well from the RBA, because they're trying to encourage us to take our cash out of savings and put it back into the economy. That kind of sums up where our Australian economy currently is at in August of 2025. I believe we will continue this trend of seeing a slowing and cooling economy into 2025. I still think, the share market and a few other markets, crypto, etc., are at all-time highs. And I believe those trends will continue slightly, but they will falter into the back half of 2025. And come 2026, I believe things will start to cool, if not collapse, in the asset markets. And I believe from there we will see essentially a bearish style of market instead of the bull market that we've seen since the C19 period. And so if you join us for our next video, what I will discuss is some important things to remember when entering a slowing or cooling economy, what you should be doing about your economy as opposed to the economy. So join us for the next video. I'm James. This has been Money Media. Thanks for joining us.